The Bitcoin Standard. For thousands of years, gold served as money. First, gold was used directly as the material to mint coins, and then gold was used indirectly as the backing, the collateral for government-issued money. However, the gold standard was abandoned roughly 50 years ago. Depending on your age, you may have been born still when the gold standard still existed. This is all very recent. Without the gold standard, governments started printing money without collateral. Money today is created at will. That is why it is also called fiat money, because fiat is a Latin word that represents the idea of let it be made. Fiat money is not backed by any precious metal and it depends on trust in the government. Therefore, fiat money is weak money, is unsound money, and weak currencies cause various problems for society. For example, we are living in an era of high inflation, currency wars, debt, and economic crisis. One of the worst economic crises happened in 2008. The crisis started with the real estate market in the United States and it spread throughout the world. It was a crisis that exposed how much banks and governments manipulate the currency and interfere in people's lives. Bitcoin has the potential to redirect humanity toward the use of hard money, sound money. In late 2008, a programmer using the pseudonym Satoshi Nakamoto sent an email to a cryptography list. Satoshi announced Bitcoin, an electronic money system that does not depend on a central bank or any other trusted party. Bitcoin has almost all the characteristics that made gold a strong currency, plus it has some extra advantages. Saifedean Ammous comments all these advantages in his book, The Bitcoin Standard, the Decentralized Alternative to the Central Bank. It is a book that presents several ideas about economics and the role of money in our lives. In today's Arata Academy Summary, we will be understanding the ideas behind this book, arguing that we can have a Bitcoin standard similar to what we had with the gold standard. Please take note, this is a summary of a book. Please read the full disclaimer before proceeding. Money is made to move value through time and space. Interestingly, this book talks about Bitcoin only in the second half. Before that, the Bitcoin standard focuses on the general context of money and its main functions. So, what is money? Money is an instrument to solve a problem that persists throughout human history. How to move value through time and space. The simplest solution is direct exchange. Barter happens when valuable goods are transferred, exchanged between people. For example, I give you some fish, and then you give me some fruit. The problem is that barter only works in small groups, and it depends on the double coincidence of wants. You have to want what the other person has, and the other person has to want what you have. Money simplifies the situation. First, you exchange your goods for money, and then you exchange the money for another good that a person wants to exchange for money. This is called a medium of exchange. Money can be viewed as a good that is widely accepted as a medium of exchange. Different peoples have experimented with various types of money. Some of them seem very strange to us today, such as beads, giant stones, and seashells. But the main form of money in human history is precious metals, especially gold, silver, and copper. This has been the case for over 2,500 years, since the first minting of coins in the ancient Greece. Precious metals are a great money option because they have high salability through time and space. Salability is liquidity. It refers to the ease in which a good can be sold whenever the owner wants, for the amount that they want, and whenever they want to sell it, with little loss in price. High salability, combined with a good relationship between stock and flow, gives strength to the currency. The strength of a currency is defined by the relationship between stock and flow. This relationship indicates the ability to preserve value over time, and precious metals are relatively scarce, durable, divisible, portable, and they have value in themselves. Gold and other precious metals manage to retain value in the future. Therefore, in addition to serving as a means of exchange, they also fulfill a second function of money, serving as a store of value. A good store of value needs to be a strong currency. And what determines the strength of a currency? The strength of the currency is determined by the difficulty of finding these precious metals. When it is difficult to increase the supply of a good that serves as money, we have hard money, we have sound money that manages to preserve value. Now, on the contrary, when it is easy to increase the supply of a good that serves as money, we have weak currency, unsound money. For a more detailed explanation, you can see the episode number 2 of the Money Arata series. One way to understand the strength of a currency is by looking at the stock-to-flow model. Stock is the inventory that already exists in the market. Stock considers everything that has already been produced from a currency that is still in circulation or that is stored. Now, flow is the production of new coins in addition to the existing stock. For example, you can measure annual flow, which is how many new coins are being produced within a year. The greater the stock to flow ratio, the greater the strength of a good, such as money. That is, the good has a high probability of maintaining its value as long as demand remains constant. Now, why do we need to understand the strength of a currency? Why are we talking about this? Because there is a problem. As follows: people want to preserve their wealth. Therefore, they seek a currency that can serve as a store of value. The purchase to accumulate hard money increases the demand for hard money itself, and great demand drives up the price. In addition, increased demand is an incentive for the producers to be increasing the supply. That is why not every money is sound money. Weak money suffers the effect of the increase in production and increase in flow. On the other hand, producing hard money is always difficult. For a currency to be sound, there must be some difficulty in increasing the supply. And gold, in that sense, is hard money because you can't create gold easily. The mining process is very expensive and slow with the current technology. The flow of gold production is very small compared to the huge existing gold stock. For an in-depth look at stock to flow, you can watch episode number 9 of the Money Arata series. In weak currency, the opposite occurs. Take the case of money that we use daily, which is fiat money. Why is government money considered a weak currency? Well, the reason is that government money can be created in large amounts with ease. It is money with low scarcity. The inflationary supply reduces the value of currency and devalues the wealth that you have worked to accumulate over the years. This destroys the currency's sellability over time. To see the weakness of your current currency, you can compare what you could buy with a 100 bill 10 years ago and what you can buy today with the same cash. Why do we use this weak currency? Because basically, we are forced to do so by law. Each country has a legal tender dictating which currencies can be accepted. Now, the opposite of currency that is imposed by legal tender would be sound money. Sound money is the one that emerges through free choice in the market without the imposition of an authority or law. Sound money has its value determined by market interaction instead of government imposition. Forced currency is only accepted where the law applies. People are forced to exchange currency from one country to another. Sound money has high acceptability. For example, you can sell a good coin almost anywhere in the world. Stronger currencies become the unit of account to serve as a reference for weaker currencies. Wide acceptation of a medium of exchange allows for pricing calculations. Therefore, in addition to its role as a medium of exchange and as a store of value, money has also a third role, to serve as a unit of account. In an economy with no recognized medium of exchange, each product has to be priced in terms of another product. For example, Envision living in some imaginary island that works through barter, right? So you have a boat, and then you decide that you want to exchange your boat for 2 cows. Then one person is interested and appears but has no cows, but they can offer you 50 chickens. Are 50 chickens equivalent to 2 cows or a boat? You see how the absence of a unit of account makes this type of economic calculation increasingly difficult. Now, on the other hand, when an economy has a recognized medium of exchange, all prices for every good are expressed in terms of the same unit of account. A good clue that you're dealing with a weak currency is when you need to convert the value of that currency to another, stronger benchmark that serves as a unit of account. This occurs in Argentina, where some people often convert prices from pesos to dollars to understand the true price of a product. So far, we've covered the 3 basic functions of money: serving as a medium of exchange, serving as a store of value, and serving as a unit of account. These 3 functions will help you to better understand Bitcoin. Gold served as a medium of exchange, store of value, and unit of account, but it did not serve interventionist governments. To put this book into context, you need to understand that it has ideas with line with the Austrian School of Economics. It even makes some personal attacks on other economists who represent today's dominant thinking among government agencies and universities. The Austrian school advocates almost total economic liberalism, eliminating or reducing government intervention in the economic matters. The idea is that without government interference, the market would regulate itself. This would form fair prices, achieving maximum effectiveness through free competition. Now, within this context, there is emphasis on the gold standard that lasted more than 2,500 years. When the gold standard was used, government issued money had the gold equivalent held in their vaults. So, at that time, a $100 bill represented an amount of gold equivalent to that 100. And that gold existed somewhere, stored in a vault. After the Second World War, the welfare state emerged, in which the government took care of people more directly. This obviously required a lot of money. But the government couldn't create more money without having the corresponding gold. What was the solution? The solution was to abandon the gold backing and then issue unbacked money. Thus, the gold standard was falling until its total extinction in the 1970s. The gold standard had enabled trade on a global scale, as well as the accumulation of wealth. When the money supply exceeded the amount of gold that the banks and governments had, then the currency was devalued. The inflated supply of money goes against the logic of the gold standard. It destroys the function of money as a store of value. As we have seen, a good functions as a store of value when it appreciates in value, or the demand for that good increasing. But it is essential that the supply of this good is not inflated to the point of lowering the price. And due to its natural characteristics, gold is almost perfect as a store of value. Gold is difficult to destroy, but it is also scarce. Think of all the gold that is mined on the planet. Since the beginning of humanity, nearly 5,000 years ago, the total volume of gold that has been mined is less than 4 Olympic swimming pools. In addition to being basically indestructible and scarce, gold is not easy to produce. The only way to get more gold is by mining the crust of the earth, which is an expensive, toxic, and uncertain process. In the last 70 years, the stock of gold has never grown more than an annual rate of 2%. Because of this, gold has maintained its monetary role throughout history. Even with the abandonment of the gold standard, the gold reserve in the central banks of several countries is still very large because they know that gold is very useful as a store of value. And we are forced, by law, to use government money that is not redeemable by gold, a weak currency that destroys our wealth over time. After the gold standard was abandoned, we entered the era of the government money, which is not redeemable by gold. Now, Each government prints as much money as they want, since the only backing of a currency is the trust in a issuing government. Unlike gold, government money can quickly increase its flow compared to the stock. This causes a rapid loss of salability, destruction of purchasing power, and the impoverishment of those who keep that money. The ease of printing money is very tempting for the rulers. Politicians are in power temporarily. They need money to do public works that prove that they are useful. It is much easier for them to pay for those works by issuing money than to be taxing voters even more. In the 1970s, government money that was non-redeemable for gold became standard in most countries. And then since then, we have been in an era of massive government intervention in the economy. It is a model that prioritizes central planning and encourages spending, while reducing the incentives for the citizens to be saving money. A milestone for this new era was the Bretton Woods Conference, which took place after the Second World War. At that conference, a new monetary and trading system was being discussed. It was agreed upon that the dollar would be the global currency for trade. Central banks would trade in dollars, preventing the physical movement of gold between countries. The new global commerce didn't have a universally recognized unit of account. This brought back the old problem of the double coincidence of wants. Consumers now had to use more than one medium of exchange. The buyer needed to exchange their currency for the dollar, and then exchange the dollar for the final product, increasing transaction costs. The result was rising inflation, growing debt, shrinking savings, and currency wars. Printing unbacked money continually causes the currency to devalue. The problem with the continuous creation of new money is that a forced transfer of wealth takes place. After all, your money is now worth less. This leads people to spend more, even go into debt, because nobody wants to be holding pieces of paper that depreciate over time. Now we need to explain what time preference is. Weak currency increases time preference and discourages people from saving for the future. Consumption is necessary for survival. This is normal. There is a natural tendency for people to value consumption in the present moment more than in the future. After all, lack of consumption in the present can keep the future from ever arriving. On the other hand, excessive consumption in the present can harm our future. But what does this have to do with the discussion about the nature of money? One of the most important aspects of a hard currency is that it encourages people to consume less in the present moment and make better plans for the future. This decreases time preference. Time preference is the ratio of individual appreciation of the present compared to the future. The higher your time preference, the more immediatist you are. Animals have an even greater time preference than humans, because animals act to satisfy immediate urges. They have very little insight into the future. Therefore, the more we think, the more we save for the future, the more we distance ourselves from animals. When our ancestors devoted less time toward immediate hunting to focus on building a weapon that would make future hunts more productive, they were showing low time preference. And the lower your time preference, the more you can build a better future. Low time preference is the essence of investing. We defer gratification today to achieve something better in the future. But every investment carries the risk of failure. Therefore, investments are only made when people have some expectation of reward in the future. Every day, you engage in economic transactions with other people. In addition to trading with other people, you also trade with yourself. Would you rather spend your money today on something unnecessary, or would you rather save for the future? The transactions that you make with your future self are your most important economic decisions. To have financial peace of mind, you have to be able to save and invest, lowering time preference to prioritize future returns. But the return depends on the future value of money. See, if the money that you have in your pocket is devaluing and you buy less and less each day, you will be incentivized to spend your money as soon as you get it. The opposite is also true. The better money is at preserving value, well, the more people want to save it. The government encourages consumption rather than encouraging people to be saving, to delay gratification. Citizens are swayed to buy until they fall into debt. This is one of the major problems with government money, which doesn't retain its value over time because of inflation. A theoretically ideal money would have a fixed supply, so no one could produce more of it. The only way anyone could get that money would be to provide something of value to someone else in exchange for a payment. With everyone wanting more of that money, people would work harder, they would produce more, this would be leading to an improvement in society as a whole. A strong currency can lead to the end of excessive state planning and a return to the free market. In a capitalist system, there are two ways to allocate capital and to make decisions about which goods and services should be produced: free market or government planning. Which one do you prefer? Would you rather allow the market to organize itself? Or would you prefer for the government to intervene? Let's understand these two paths in a simple way. In a free market theory, prices reveal information. Prices are part of the economic production information system. It is necessary to communicate this information objectively, to collaborate, to produce. Prices free from government interference are information, as they make your purchasing decisions by looking at prices. In a free market, these prices should reflect the composition of all conditions, all realities. It is prices that help us to carry out division of labor and specialization on a global scale. The most productive way of allocating capital goods is through the price mechanism, freely formed by the law of supply and demand. On the opposite side of the free market, there is government planning. And currently, all countries have a central planning council for the capital market, and governments often interfere in the formation of prices. This is why many advocates of liberalism and the Austrian school criticize government economists, and why government economists despise the ideas from the Austrian school. This gets even worse when the debate is infantile, as we have seen in the episode number 10 of the mini Arata series. Centralization suffocates the free market. When prices are not freely formed by supply and demand, there is no rational way to define the most productive uses of capital. Nor is there a rational way to determine how much or what should be produced. The difficulty with centralized planning is that governments will never be able to know the preferences of each person, nor allocate resources in a way that meets these needs. Even if they did, soon afterwards the needs would change and the system would have to be adapting again. Sound money should give individual freedom and sovereignty over money itself. And Bitcoin can do this. You can just read any book on personal finance. You'll find a basic principle that anyone must follow in order to be financially responsible. Spend less than you earn. When money was backed by real wealth, like gold, governments had to be fiscally responsible. There was no central bank that could print money to pay off government debt. Therefore, public budgets had to spend less than they earned. This is why a strong currency favors individual freedom. If the government doesn't have the money to provide a welfare state, well, each person must have the individual responsibility to work and save and ensure their own welfare. The government doesn't need to be managing the money supply when we have a strong currency. People themselves can do this. Bitcoin demonstrates this power with its scarcity characteristics and the issuance controlled by the network itself. Bitcoin overturns the theory that money is what the government determines by law to be money. In just a few years, Bitcoin has achieved currency status. Bitcoin has gained greater value than most state currencies because of its reliable scalability. And this is exactly what the Austrian School of Economics advocates. Hard currency naturally emerges as the most tradable commodity and the most saleable asset. Hard currency is the only asset that holders can sell more easily on favorable terms without government interference. Bitcoin could be the ultimate money solution with advantages even over gold. Bitcoin is the first truly digital solution to the money problem. Bitcoin solves the issues of scalability, solidity, inflation resistance, and sovereignty. Bitcoin is scarce, divisible, and immutable. It is issued by fixed rules using automated, pre-programmed decisions that are free from the whims of a central authority. Even without a central administrative structure, Bitcoin is adopted by millions of people around the world because it offers a real benefit to its users. Bitcoin has the same convenience as cash payments. Payments are direct between the participants who don't need the trust of a third party in the transaction. The person receives the money to the other, they receive something in return, and that's it. There are no limits, no conditions. There is no one dictating what you can or cannot do with your money. Can you understand the problem of centralizing money in the hands of a trusted third party? The problem is that when the money is centralized, it is not really yours. Sending money digitally over long distances is nothing new. Credit cards, bank transfers, services such as PayPal also allow remote transactions, but they centralize the payment. At any time, you can have your money frozen. You can get kicked out by the system or can be forced to accept new rules or new conditions. Bitcoin eliminates these inconveniences. It is the user network itself, with its programmed logic that serves as a trusted third party. Bitcoin was also innovative in solving the double spending problem. Imagine this. If I email you a digital file, now I have that file and you also have a copy of that file. Digital money couldn't work like that. Bitcoin solved all this with a sophisticated computer engineering solution. Bitcoin invented digital scarcity by allowing the entire network to verify and prevent double spending. Furthermore, Bitcoin was programmed so that its offer could not be changed by any party. There will never be more than 21 million Bitcoins in circulation, no matter what. Each of those Bitcoins is divisible into 100 million pieces called Satoshis, ensuring that it is saleable at various scales. All this was achieved thanks to a combination of mechanisms that already existed separately, such as encryption, distributed networking, digital signatures, and proof of work. Gold was an inspiration for Bitcoin. It is not by chance that the process of generating new Bitcoins is called mining. Bitcoin mining is intentionally labor-intensive, requiring much investment. The difficulty level in Bitcoin mining is adjusted as more miners are competing. Difficulty adjustment is the most reliable technology for generating hard currency and limiting the increase in the stock-to-flow ratio. At the same time, this is the work that the miners do that guarantees the security of the network. Even though it is worth a lot of money, the Bitcoin network has never suffered a successful hacker attempt. People who buy Bitcoin hold the coins as a store of value. Therefore, the price continues to rise in the long term among many short-term swings. This short-term volatility happens because the supply of Bitcoin is totally inflexible and it doesn't respond to the changes in the demand. You can't produce more Bitcoins just because more people want it. The total supply of Bitcoins is programmed to grow at a predetermined rate, and you just can't change that. Volatility scares many people and it drives some people away from Bitcoin. But as the market size grows, volatility will level off. The network will reach a stable size with relatively equal inflows and outflows of funds. Bitcoin is the first commodity in history with truly limited scarcity. In absolute quantity, almost all available resources on the planet are practically unlimited for human beings. If we consider gold to be scarce, not really. We have barely scratched the surface of the earth in search for precious metals. And the more we dig, the more resources we find. The limit on how much of these metals can be found is also not their absolute quantity. It's the opportunity cost. Proof of this is that gold, the most precious metal of all, has been mined for thousands of years. And it continues to be mined as our technology advances. The practical limit on the quantity of any natural resource is always time. That is, the amount of time a human can spend producing that resource. Time itself is the only truly scarce resource. at least until the creation of Bitcoin. All people have a limited amount of time to live. This limited time causes a dilemma regarding the question of how to store the value that a person is producing throughout his time. You want the wealth that you can produce today to be preserved for when you're older. This is only possible if there is strong currency with a high stock-to-flow ratio. Gold has a high stock-to-flow ratio. And Bitcoin will have even more. With Bitcoin, for the first time in history, we have a commodity with a strictly limited supply. No matter what you do, there will never be more than 21 million Bitcoins. This amount will be reached around the year 2140. If you have Bitcoins, you have preserved the value that you have produced over time. This is only possible due to digital scarcity. There was nothing in the world that could have been achieved this level of scarcity rate before Bitcoin. That is why Bitcoin is perfect for serving as a store of value over time. Bitcoin is the cheapest way for you to buy the future because Bitcoin is guaranteed to not depreciate with increasing supply. You'll never be diluted. Even though more and more people want Bitcoin, the only way to meet this demand is through the appreciation of the existing supply. Bitcoin's greatest achievement is making you the true owner of your money. Bitcoin has a guaranteed store of value. Most importantly, Bitcoin gives anyone access to a sovereign cash base. If you have Bitcoins, you have a degree of economic freedom that was not possible with other currencies. You can send massive amounts of value across the planet without asking anyone's permission. You are assured that this Bitcoin can never be completely stopped, destroyed, or confiscated by any force in the political world or in nature. With Bitcoin, anyone can escape the financial influence of the governments that they live in. And this can be seen through the wide use of Bitcoin in countries that are facing serious financial crises. If a person needs to flee a country in crisis, they only need to memorize their password. This is simpler and safer than trying to cross borders with banknotes, with gold, with jewelry, with cards. With Bitcoin, there is nothing that the authorities can confiscate. No government is authorized to issue Bitcoins. They can't do that. And Bitcoin doesn't depend on the country's economic performance. That is why Bitcoin can play the same role that gold played on the gold standard. Hence, the title of this book, The Bitcoin Standard. Bitcoin is a neutral currency for an international system. More than serving for day-to-day payments, it is possible that Bitcoin will have the same role of backing in the future, similar to how there was gold backing in the past. Central banks may consider supplementing their current reserves of gold and other hard currencies with Bitcoin. This can act as insurance for central banks in the face of Bitcoin's success. If this successful scenario comes to fruition, Bitcoin could serve as a unit of account. Since the end of the gold standard, international trade has suffered from currency wars, currency conversion costs, and other difficulties. Now, if the Bitcoin standard comes a reality, all of this could be behind us. Scalability is the ultimate challenge for implementing the Bitcoin standard. The final part of the Bitcoin standard book is dedicated to answering specific questions about Bitcoin. The author clarifies, for example, that Bitcoin mining is not a waste of resources and electricity. On the contrary, Bitcoin is a technology that converts electricity into true records through the expenditure of processing power. And this ensures the security of the network. We have already clarified this point in the episode number 7 of the Money Arata series. The book also talks about the advantage of Bitcoin being immutable, showing how other cryptocurrencies have not been able to achieve the same success. It clarifies the false idea that Bitcoin is heavily used for illegal activities. All of this is very interesting, but the question that many people have, they ask, is whether Bitcoin really can handle all the financial transactions in the world. Well, this would require enormous scale. To answer this question, it is necessary to understand a little bit about the technical part. There is a base layer of transactions, which are also called on-chain payments. They are recorded on the Bitcoin time chain. Now, to achieve the scale that is necessary to process more payments, there are already new solutions. They are called Layer 2 solutions. This is a topic that we'll go into more detail in other episodes. The conclusion of the book, published in 2017, is very bullish for Bitcoin. Nothing is guaranteed for the future, but we could be facing a great revolution, and we need to take more advantage of this unique opportunity to the best of our ability. For thousands of years, gold served as backing to control the responsibility of the rulers in relation to money. Bitcoin can do the same in the future and still have extra advantages because it is purely digital currency. The idea of having a Bitcoin standard is encouraging. It makes us wonder if we can go back to a world with hard currency and less government intervention in the economy. For you to prepare for this new world, you need to acquire knowledge. That's why I invite you to discover our Diamond Hands course. In this course, you will learn everything you need to know about Bitcoin in an easy and straightforward way. And you can learn more about the Diamond Hands trainee right now by visiting arata.se/Diamond Hands.